In terms of big, interesting and difficult jobs right now, given what the economy is going through, given what we're seeing with inflation, there's perhaps no more interesting person for us to have than the new Chief Economist of the Bank of England. So it's a real pleasure and an honour to welcome today Hugh Pill. So much the better that he's also a Welshman. We are also glad to welcome Jagjit Chadha, who has some publications on monetary policy. I know lots of you were interested in buying them. The shop was closed. The shop will open shortly after this presentation, and I'm sure Jagjit will be very happy to sign them. And they are going to be joined by the Britain economics correspondent, another fantastic communicator and economist, Soumaya Keynes. So I'd like to welcome Soumaya and her panel.
Hello. The fun fact for you all is that Richard is the one who hired me at The Economist. So it's all down to him. Hi, everyone. Thanks so much for coming. I'm Soumaya Keynes, and I'm very, very excited about this conversation. Okay, so I think we should just dive straight in. So Hugh. Bank of England. It looks at the economy, it looks at inflation, and it pulls its levers. So as you look out there, what is going on? I mean, we've all seen the headlines. Inflation is higher than it normally is right now. What's going on?
Well, first of all, let me say thank you for inviting me, and I kind of got a big build-up. I'm not sure I will meet that, but anyway, I'll have a go. Look, as we look at the economy, I think there's good news and there are challenges. So the good news is, go back 18 months, we were being affected by a pandemic, a lot of uncertainty, economy was shrinking very rapidly and very significantly. I think monetary policy and the bank's efforts on other dimensions too, in concert with many other policies, has created a bridge across the kind of COVID valley. That bridge is well established. We have enough momentum, I think, to traverse that bridge. So that's a big achievement. And I think monetary policy, in concert with other policies, has contributed a lot to that achievement, and I think is a substantial achievement.
Central banker says monetary policy has done really well.
So I recognize there are some challenges, and it's a pretty uncomfortable time to join a central bank. So I've only been in the job for just over 2 months. There's limits how much you can blame me for things thus far, and I will make use of that excuse to the extent I can.
For the next 3 years.
But there are challenges, and it's an uncomfortable situation to be in an institution and represent an institution that has a target to have inflation be sustainably at 2%. And inflation, as we saw this week, is well above that, more than double that, and I think it's set to rise further. I think one clear message I can give in an uncertain world is that I personally, and I think the bank as an institution, and the MPC, which is the body that sets monetary policy at the bank, with this goal of achieving 2% inflation, we are committed to doing that. There's no quick fix, and that lack of a quick fix means some patience will be required. But I'm sure we'll talk about how we'll set about doing that. Mm-hmm. But maybe I'll pass over to Jagjit to give his sense of where we are.
Thank you, Hugh. Thank you, Soumaya. I was very pleased to be here this morning with two old friends, Hugh and Soumaya. I should say I'm Director of the National Institute of Economic and Social Research, have been for 5.5 years. And from that perspective in Westminster, I had a wonderful opportunity to observe developments in the British economy. And I've got to say they've mostly disappointed in that 5-year period. And where they're disappointed, I want to make clear, are very much outside of the remit of the Bank of England. The British economy has suffered from what's called a productivity puzzle, but in normal language is just a lack of supply capacity. Productivity has been low, our ability to deliver goods and services given level of inputs has not been good. The uncertainty around Brexit has crimped firm investments. Firms have waited to invest in order to understand what sort of deal we'd have with the rest of the world, and we don't have one, and it keeps looking like it's changing. So firms haven't got a strong basis for planning ahead. That affects their investment, as I've said. It affects foreign direct investment, the extent to which we learn from abroad. people bringing capital into this country, their ideas, their skills, their dynamism has been crimped in this process. And as well as that, labour supply has been crimped as well on the margin. You only have to visit a restaurant or any other sort of place where we meet people to realise there's a severe shortage of labour. So these supply problems, to be clear, are completely outside the remit of the Bank of England. The Bank of England's job is to ensure price stability, however defined. We had a debate when Hugh and I were lads about what price stability was, and it's something around 2% inflation. I can go into the details of that a little bit later on. And if we look at the long record of the bank since the Monetary Policy Committee, it's met that objective. So what was its job when it went into the crisis 18 months ago? It was to help us deal with a shock that none of us had to deal with in our lifetimes. It looked at the rule book, decided to increase the quantity of quantitative easing, which I can talk about later. In fact, I talk about to the point of boring everyone in my family about it. And also cut interest rates to provide some comfort to people that the economy eventually would stabilise. We're now in the tricky part of the crisis. What we can find from the historical record when we come out of crises is there's often economic dislocation. We can see that after World War I, we can see it after World War II, we can see it any time there's a big shift in the economic tectonic plates, there's a problem. And so the bank's problem right now is to manage that, having injected demand into the economy, with fiscal policy also having been expansionary for a while. How does it normalise its interest rate path and contain the inflationary pressure that is obviously emerging from the numbers that we're seeing today? And that is the problem. What it did last year was great, but it's facing a problem right now about managing that inflationary pressure that we're seeing.
So you just mentioned Brexit
Yes.
and this kind of hit to investment. And so I had a question about scarring. Right, this is one of the big debates. Fundamentally, we just don't know the exact extent of the permanent damage to the economy of these two whacking great shocks that have just hit. Right, we've got Brexit and we've got COVID. So, Hugh, can you kind of tell us how you're thinking about the relative magnitude of those two shocks? How can we get beyond just guesswork of the permanent effects? And why does it look like other countries have had different scarring effects?
Well, I mean, big picture, what we've seen, what we're trying to do is steer, using the tools we have with monetary policy, trying to steer aggregate demand in the UK economy to more or less meet aggregate supply in the UK economy. So we're not building up sort of big pressure on resources, which would lead to higher inflation. So that's the kind of big picture. As Jagjit has just described, and you're asking about, we do not have the tools directly to influence the supply side of the economy, the potential of the economy to be producing things. And yet that supply side of the economy has been hit by enormous forces. COVID, Brexit, technological change, demographics, one can make a very long list. And things which are outside the scope, really, of monetary policy to influence directly or at all. So, of course, we have to look at those. And your question is, how are we looking at those? What assessments we are making? So, I mean, one question is, are the things that are influencing the ability of the economy to produce, are they having a permanent effect or are they having a temporary effect? So when we talk about scarring, we're really focusing on the permanent effect of all these things. And the bank's made a number of assessments, which have been published. There's an impact stemming from Brexit, which is about 3.5% on the amount of output the economy can produce, spread over a 15-year period. So that's the published view. We've also said things about scarring stemming from COVID. So the published view of the bank has been that probably will weigh permanently on the amount the economy produced to about 1%, so a smaller effect, but one that's there forever, if you like. Now, what I think is increasingly becoming obvious is that our ability to separate out these various strands and indeed separate them from all these other forces, the demographic forces, the technological forces, etc., which are anyway going on in the economy, I mean, is becoming more and more difficult. So, when we first talked about the scarring stemming from Brexit, what we were doing is, let's take our forecast that we published at the end of 2019, pre-pandemic period, let's take our forecast today and compare where we think the economy will be at a longer-term horizon, that gap would be a natural measure of scarring. The trouble is, back in 2019, we weren't producing forecasts for 2024, 2025. So our ability to make that comparison has kind of disappeared. What's more, a number of other things have happened. We've got new data on the structure of the population, including some of the forces that Jagjit described. We've also learned more about, are people retiring earlier as a consequence of health concerns? People are sheltering, maybe they don't want to go into offices or workplaces, so they retire earlier. So there are lots of forces which are related to COVID, maybe they're related to Brexit too, and maybe they're related to underlying technological and demographic factors. So I think net, it becomes increasingly difficult to work out what the driving factor is, and these things are actually very closely interrelated. But at least our current view is the overall impact of where we think the supply potential of the economy today is relative to what we might have thought pre-pandemic, contributed by a whole set of factors, is probably somewhere in the sort of 1.5% lower, of which probably 2/3, so not dissimilar from our previous assessment, is coming from COVID forces. Relative to some others, I mean, Jagjit will talk to the NIESR forecast, but for example, the Office for Budget Responsibility, I think this is actually a relatively small extent of scarring. But I think we're increasingly confident that's broadly speaking, the right ballpark figure. And I think other forecasters have kind of come towards us in that respect. What I'd also say, perhaps, is that we also think, though, that the rate of growth, even though we're kind of stepped down in terms of level, the rate of growth, which we sort of think on a long-term basis is about 1.5%, that's what we thought pre-COVID, that's what we still think. So it's a sort of step down, but a still the same rate of growth.
Okay, so before this happened, we were in the green room, and I said, you have to disagree. I gave them very, very strict instructions that they weren't allowed to be too friendly. So where do you disagree? Why is the Bank of England's estimate of the permanent hit of all of this stuff completely wrong?
Well, I have to be careful what I say, because the bank is a firm and avid consumer of NIESR's analysis on these things. So one thing is that NIESR does produce longer-term forecasts, so we're exactly able to do the comparison that you suggested the bank is unable to do. So it's a typical way that economists think about things. Where do we think we'd be at some point in the future a couple of years ago, and where do we think we'll be now? Those expectations matter. And the kind of numbers that we've come up with are not, unfortunately, that far away from where the bank is, but I'm going to move on. I don't think it's that pertinent a question, other than when you're thinking about tax revenues, possibly. I think the thing to say to ourselves is, what have we learnt about the economy that we didn't know before COVID? That's a really important thing for economists. We draw expectations and plans on the basis of information. Stuff happens, and then we learn, and then we reformulate our plans. So what do we know? There's no trade-off between health and the economy. One of the things we have to guarantee is high and stable levels of health for people across the population. So what does that then mean for the economy? We have to effect transitions in labour employment from certain sectors to others that are going to be able to support that level of health. We know that technology can advance very quickly, and skills that are based, or jobs that are based on high skills levels or technological improvements, are going to be more stable, robust jobs than other types of jobs, and they're the ones that we need to bring about. So I could go through a whole list of things, but we've learnt those transitions matter. So what we need are policies that help those transitions. Now, lots of those are the problem of the Treasury, their fiscal policies. How do we retain skills? And that's where, for example, furlough has been very helpful. It's allowed firms to hold on to staff with firm-specific capital and not let them go. That would have been a great source of scarring in the economy. Imagine a whole bunch of firms hadn't got the funds to pay salaries. They let large numbers of people go. What happens is their skills depreciate incredibly quickly. They get dislocated into other jobs markets. Then you get these kind of large permanent effects. Furlough stopped that. So that's something the Treasury did, and it's something we argued for very strongly at the Institute. Now, what can the bank do in that area? Well, what it needs to ensure, whether it's monetary policy or financial policy, which is arguably outside of U's direct area, is to ensure there's significant amount of finance across the country for firms to start up with new ideas, to remain in place, to ensure that banks don't close down firms too quickly, and there's forbearance. So there's a kind of other aspect to the transitions that we're talking about that are more important to me than some measurement of scarring. And I say that because, you know, I've been in this game quite a long time, and trying to measure things in real time is phenomenally hard. Trying to guess how much capacity there is in the economy, and capacity we mean that thing Hugh was talking about, the difference between aggregate demand and supply, is often used to generate inflation forecasts and those kinds of things. But I think that's a crazy thing mostly to try and attempt. It's almost impossible. So in the same sense, scarring is impossible. But what we have to do is affect those transitions, and I think that's a much important problem. I hope that's enough of a disagreement with Hugh. To be able
Well,
to say.
you were disagreeing with me rather than with Hugh.
Oh,
So
okay.
that's definitely not what I thought you to do.
No, I'm in trouble now.
Yeah, massive trouble.
Yeah.
Okay, well, let's kind of go on from the state of the economy and talk a bit more about what's going on today. And I want to talk about communications. So for those in the audience who've been following the minute-by-minute developments of the last few months, there was a bit of an event. So essentially, some people in the market, some investors who were watching the Bank of England very, very closely, got the wrong end of the stick. They thought that the Bank of England was going to do something at its last meeting, and in the end, the Bank of England didn't. And so for a while, there was this sort of mismatch between what people thought the bank was going to do, and then there was a difference between that and what actually happened. And so my question is, does that kind of mismatch, does that phenomenon of people getting completely the wrong end of the stick about what the Bank of England is going to do, does that matter?
That's for me.
Yeah. Oh, yeah.
I thought it might be. It matters, but maybe it matters less than people in the markets sometimes think. So let me kind of expand on what I mean by that. I think the discussion we just had and the framework I think we're thinking about monetary policy, for exactly the reasons Jagjit said, so I'm agreeing with him. Sorry for that. But what I'd emphasize is we're talking about big movements in demand in the economy, in supply of the economy. We're actually talking also about big movements in the composition of demand and the composition of supply in the economy. And what we're actually focused on is often the differences between demand and supply in the economy, both in aggregate and in specific sectors, because this is how we're generating resource squeezes, pressure on prices, and ultimately inflation. Now, those things, even in the face of the big transitions of Brexit and COVID and all the things we've been talking about, they are not things that resolve themselves on this minute-to-minute basis. So if we want to run good monetary policy, we need to be looking at developments in the economy through a sort of medium-term lens. And we need to be implementing monetary policy through the same medium-term lens. We can't get caught up into the sort of minute-to-minute, dare I say it, media-driven, dare I say market-driven dynamics, which I think can be problematic. So that's my view, and my view is monetary policy has to focus on what an economist might call the lower frequency, the more persistent, the more underlying movements in economic data. People in the media, people in markets are always looking for the smoking gun, that indicator like inflation coming out at 4.2 instead of 4.1 on Wednesday. Does that mean the Bank of England's going to move? I don't think about my decision, which I have to vote on any month in the MPC, about any one indicator or any 1/10 of a percentage point one way or the other. I'm looking at the way the economy as a whole, across a broad set of indicators, has evolved through time. And that's why, as I said at the beginning, I have comfort that there is a recovery in the economy. There's momentum in the activity in the economy, which is allowing us to traverse this bridge across the COVID valley. I also recognize, as again, unfortunately agreeing, that we're emerging from a situation where there has been disruption from supply and inflation is rising. So we're going to have to make assessments on whether this is permanent, is this temporary, all the things we've been talking about. What's the impact of inflation at the horizon at which we can affect inflation? And all of this means that we can't be setting monetary policy just on this minute-to-minute basis.
So I don't think that was... so the question wasn't... clearly, yes, right? Clearly, monetary policymakers shouldn't be reacting to every, blow of the wind in whatever direction. I guess the question is it a problem that actors out there in the real economy have kind of fundamentally got wrong, that they didn't, for that period, didn't understand what the Bank of England was going to do?
Right. Well, I mean, so my kind of response to that would be, having said what I've said, what I'd like my colleagues in the media and my colleagues in financial markets to think more about is precisely this more medium-term oriented, this sort of more lower frequency, to use a bit of jargon, not focusing on a specific meeting, not focusing on a specific data release. Now, as you know, I used to work in financial markets, so I know what the environment is. So people who are in those jobs, they're having to make judgments on these things. But the point I want to make is that we are thinking and communicating, I would like to hope, in a way that is emphasizing, at least in my personal case, these underlying movements. And what I'd like to do, which is a little bit patronizing maybe to say, but I'll say it anyway, in the hope of not being seen as patronizing, is I'd like to think that we're trying to train people to think the right way about monetary policy. Because good communication is where someone speaks and someone listens, and you come to a common understanding. I accept that the last few weeks have not been a demonstration of that in the interaction between the Bank of England, financial markets, and the media in the UK. But I think it's a process we need to get to a common understanding, so what's spoken in both directions and what's listened to in both directions leads to the same view of the world. Mm-hmm. So I don't think I or the bank or any policymaker really, wants to introduce unnecessary volatility into what's going on. But at the same time, we want to say what we're doing as clearly and as transparently as we're able to, and honestly. And I think what we also want to do is, if we can generate the genuine understanding, we'll take out unnecessary volatility, but it's also important that we don't try and suppress artificially volatility which reflects the true uncertainties in the economy. Mm-hmm. So, I will have to make a vote on the MPC in a couple of weeks' time in December. I'll have to make another vote on the MPC in early February about what to do with monetary policy, what to do with bank rate, what to do with interest rates. I genuinely do not know today how I will vote, because there will be lots of things that can happen between now and then. So there is a genuine uncertainty today, even in my own mind, about what I'll do on those occasions. And I'm only one vote of 9 people who are all stating the same uncertainty. So if we try and somehow artificially suppress the uncertainty that's coming in the data, we're actually misleading markets. Mm-hmm. Now, can I say one more thing?
You may.
I did tell you that you should stop me speaking for too long. And now, what I would say is there are specific challenges right now in how we communicate. Central banks in general, including the Bank of England, have spent most of the last 18 months, and arguably most of the last 15 years, since the onset of the global financial crisis, saying the economy is somehow in trouble. Mm. We are going to support the economy, and our support for the economy will be to provide easy, accommodative, supportive monetary policy. We're going to put interest rates very, very low, and we're going to do other activities like QE and so forth. So the message of monetary policy has been very directional. We are here, we are supportive in the face of a risk that the economy will somehow fall into a slump, a very persistent slump. But there's, in a sense, a story of success, a story of crossing the bridge that I was talking about earlier, is now risks are becoming two-sided. There's the risk that we put too much ease into the economy and we generate excessive inflation. But there's still a risk that we put too little support into the economy and we fall into, if you like, the trap of unemployment rising, standards of living falling, etc. So the challenge for us is to steer a course, the kind of Goldilocks path, not too hot, not too cold. And that's a very different form of communication, right? It can no longer be a communication that says, we're always here, we'll always do more money, more support, etc. It has to be, well, maybe if things turn out in a certain way, we'll do more. Maybe if things turn out in another way, we'll actually do a little bit less. And we're always uncertain which side of that debate we will be. So my point is that in this kind of achieving good understanding, we're entering a new phase, and there's a bit of learning, right? I recognize there's learning on the bank side and my personal side, but there's also a bit of learning of how to do it on the market and media side. And I think some volatility in that environment is inevitable. But what I hope is that we take a bit of that cost up front, and I think we have, but that's an investment to a better relationship and a better communication, recognizing that these two-sided risks are where it heads in the future.
Okay, thank you. There's an exceptionally clear outline of the issues the banks faced, and also the central bank support around the world to the economies since the financial crisis. I think it boils down to a number of questions. Do markets and individuals, often called Main Street and Wall Street, understand fully the central bank reaction function? Do they know what the bank will do to rising inflationary pressures, at what rate they will change interest rates, and to what level they're going to change those interest rates? That really matters in the long run. He was right to say that short-term interest rate movements are not that important. What matters is the medium term. And I don't think actually there's enough understanding of that in general as to where we're going to go with interest rates. On the other hand, he's also right to say that we don't want central bank to suppress artificially the genuine level of uncertainty in the economy. Probably, along with you, only a couple of people old enough to understand what was happening prior to the financial crisis, where two of the major central banks in the world, the Fed and the ECB, were adopting policies where it was absolutely clear to market participants what was going to happen every subsequent meeting, to the extent to what I think they were suppressing genuine uncertainty about the state of the economy at the time. We had a long sequence of increase in Fed funds rate of 25 basis points that was signalled from meeting to meeting. And I think that played a role in stoking up the financial exuberance that then led to the financial crisis. So it's very important we get across that level of uncertainty. But I think the focus that we have in the UK on the next meeting, rather than the path of interest rates and its finite level, is contributing to this level of misunderstanding of where policy is going to go. We don't or never have completed forward guidance in something I've argued for a number of years, and that would be where individual members of the MPC, possibly using their own model or view on the economy, would outline their own view on the path of interest rates. That doesn't bind their hands because that's conditional on a particular set of assumptions or a model that they may be using, that would give some idea to people as to where interest rates are likely to go over the medium term. Bank rate at 0.1, that's a tenth of 1%, I'll tell you now, is not normal. It's particularly not normal with inflation forecast to go to 5%. The real interest rate, that short-term interest rate of bank rate minus inflation, is negative of over 4%. That's completely out of whack with any historical norm. But if it is acceptable, we need to be explained to us why it's acceptable. In my own view, if I put my own view across, what we did last March was to have an emergency cut in rates down to 10 basis points and an emergency increase in quantitative easing from 645 billion to 895 billion, 40% of GDP. It's a huge amount of QE during an emergency. Again, I'm old enough to remember emergency changes in bank rate would be reversed when the emergency was over. So just as we had state contingent furloughs, we could have had the state contingent emergency intervention in the markets, which was this cut in bank rate and this increase in QE. Arguably, with output returning back to its pre-crisis level, we could reverse that. And there's some world in which the communication could have been clearer, and we could have reversed it much more easily than we decided to do. Now that doesn't by itself mean we've either got tight policy or policy that is on the path back to normalisation. Let me sort of move on with a small anecdote, if I may. I am, as well as director of NIESR, on the board of another charity. It handles a certain amount of funds, and the people who run the charity want to ensure that that charity gets as much of a return as it can from its investment so it can do more charitable work. That's what this particular charity does. I think it's probably in the public record which charity it is. And I went to one of their meetings recently where they had a presentation from one of their investment managers who was trying to understand what might happen to assets in the event of a tightening cycle. You know, that's when interest rates go up from some level to some other level. And they were trying to understand what happens to the constellation of assets as a result of that. And these people, you know, very young, which to me means under 40, let me be honest about it. Very young, and they were talking about the most recent tightening cycle in which interest rates tripled. I was going, oh my gosh, when was that? I was thinking, 1980s? Was it, what happened to the economy then? What kind of shock came along for interest rates to triple? And I sort of went, hang on, that was late 2017 into 2018 when interest rates tripled. Does anybody happen to know what interest rates went to in that period? I won't ask you. I know you know, Soumaya. You don't need to. I know you. They tripled, but they went from 25 basis points to 75 basis points. That's a tripling. So it's used in the markets as an idea that this was in some way a tightening of monetary policy. The change proportionally sounds large, but the level is by no means tight monetary policy. And I think we might have got ourselves into that little trap at the moment as well. A small change does not mean that monetary policy is too tight. It is still loose. Interest rates going up to 2%, in my view, and I don't sit on the MPC, I don't speak on behalf of the Bank of England, but I speak as someone who's worked in monetary economics his whole life, is still loose policy. And I don't think there's enough communication of that. We're constantly in this country thinking about the delta rather than the level. So I would like to see more discussion of the level of interest rates, where that might go in the medium term. What do we think long-term interest rates that will should be in order to clear the savings market in the UK? Are there some issues that we're not actually pumping out money into the real economy in the way that we might? And is that in any way being constrained because there's not a great incentive to save out there? Are we not allocating funds to the most profitable, productive firms because interest rates are so low, we're able to keep capital with firms that aren't productive, who can pay off their debt anyway? So I think there are some real questions there that the bank really ought to address, that it hasn't yet addressed. And of course, Hugh has hardly got his feet under the desk, so I wouldn't have expected to address them yet. But I think this concern about signalling that a change in interest rates from 0.1 to 0.25 would be some demonstrable shock to the economy, that it would hold it below the waterline, should actually ask us the question, is our economy so weak that that would damage it? When inflation is heading to 5%, when there is a significant risk that inflation expectations will come off and it will be more widespread and persistent and they'll be passed through, is something I'm concerned about.
Great. Okay, well, so I got a whiff of potential disagreement in there somewhere, which was about, so one of the big challenges, one of the big questions, start that again. So if you look at America, you've got the Federal Reserve, and they publish these things called the dot plots, which is where policymakers think monetary policy is going roughly in the future. They publish their expectations of that, and that's essentially what Jagjit was just saying. The Bank of England could publish, and that could be useful. So briefly, because I want to ask another question before I open it to your piercing questions that you were preparing. Why shouldn't the Bank of England do that? Briefly.
Well, very briefly, I think we just don't know enough to do it in a way that wouldn't add to confusion. So that's the brief answer, right? And I think, I have a lot of sympathy with things that Jagjit said, but one point I would disagree with him is, in this focus on levels, we are putting a very high demand on economics and statistics and my intellectual capacity to know what the right level is. And I will be honest, I do not know what that right level is. I agree with Jagjit, and this is kind of the frame in which I'm approaching my job over the last few months, and it's the frame in which I will approach the way I vote in the coming few months at the MPC, with a lot of the baggage that he is describing. The economy is recovering. We've had a very easy set of, very supportive set of monetary conditions established. Interest rates have been put at very low levels. Are those low levels still consistent with a recovering economy and rising inflation? I think I am happy to say the direction of travel from this medium-term lens that I've described is pretty clear from where we are. And I think the communication that came out of the November MPC meeting from us as a whole, as a committee, I think was pretty clear in that respect too, albeit still conditionally on the fact we don't get any surprises, who's to say what the future brings. But what I think is difficult to do is it's easy to give that direction of travel statement when you're starting a long way from normality. right? So, we've put interest rates as low as they've ever been. The economy's recovering, inflation's above target. Direction of travel there is pretty straightforward. But if we start focusing on trying to give levels 2, 3, 5 years out, you started by asking me, what's the impact of COVID? 3 years ago, no one would have even heard of COVID. So how can we really make statements that are meaningful and not misleading at that sort of horizon? So good communication for me is honest, it's clear, and it's transparent. And on this dimension, I think I would not be honest or transparent about the uncertainty of what the long-term outlook for interest rates were if I was clear that they're going to whatever level that I might put into a dot on a plot or whatever you want to call it.
Mm-hmm. Great. Okay, one last question and then it's over to you. So one thing that I think there's been research on this, which is who you are matters. Your experience matters as a policymaker, right? And so if you were in a generation that experienced the effects of the Great Depression in the 1930s, then your outlook on the economy is going to be different compared to if your primary experience was what happened in the 1980s. Or say, if your primary experience is if you've never really experienced a kind of full, mega, high inflation episode, right? And so this statement I'm making is who you are matters, right? And you can think of risks in both directions. You can think of a slightly older generation who remembers that experience of the 80s, who remembers the very high inflation, things going out of control. And there the risk is that you end up fighting the last war. Essentially, you're too heavily influenced by that experience. Now, the risk the other way is that you're young and naive and don't have any conception of what inflation looks like, and so you underestimate the risks of inflation getting out of control. Which of those two risks do you think is we're at so one, do you appreciate that there are risks on both sides, and two, which do you think is the greater risk at the moment?
Shall I go first?
Yeah, and then briefly, because I will
get your signal. What you've described there is exactly the problem with most models used by central banks and macroeconomists, because what generates inflation is inflation expectations. And most of the inflation expectations that they use in the models are bedded down to the recent history of inflation, which has been stable on target. What that means is whenever you shock the model, it gets driven back to target because those inflation expectations are bolted onto the target. And what you have to sort of think about is how you translate the ideas that you're talking about into the possibility of learning or divergence from inflation. And for that, you need to think very carefully about whether, as you said a minute ago, whether if you think of it as a generational thing, whether younger people are underestimating the inflation threat or older people are overestimating the inflation threat. And then that goes into your overall view about the risks that the economy faces. I think most of us are aware of that issue as a problem, and I think the central banker's job from time immemorial is really to think about the long run, is to ensure that historical memory is not lost, that over time we don't overweight the recent history. So the way I'd sit on the balance of that is that I'm concerned that the models are generating too much stability because the recent past has been stable. And therefore I see the risks more on the upside than the downside.
So, I think I've already said I see risk as two-sided. I think you've just elegantly described those two risks. You've associated them with the age of certain people. I guess I'm like Jagjit, more on the one side or on the other, but my son is 20 years old, so he's like a lot of people in this room. I worked at the bank back in the day in 1990. When I worked at the bank, entered the bank, interest rates were 15%. So it's not like trebling then would have, So I said to my son, I'm going back to the bank. When I went to the bank before, interest rates were 15%, and I could see the look on his face. He said, it's the sort of thing that when my dad said to me when I was 20 years old, I remember then, there were horses and carts on the streets, right? That, to him, that is just a world he cannot imagine. So I think the point which Jagjit's making, which I agree, is we have to recognize it's a two-sided risk. And in a two-sided risk world, there's the danger of doing too much and there's a danger of doing too little. That is my world. And it's like the Goldilocks story. Is it too hot, too cold?
But which is more dangerous?
I mean, I think that it cannot be that we run monetary policy only on identifying one risk in the current environment. So going back to something I said earlier, the challenge for communication today, and the challenge particularly for communicating with perhaps the population cohort that's represented more heavily in this room, is that central banks have spent the last 15 years talking about one-sided risks and speaking in a unidirectional way as a result. I mean, that's an oversimplification, but I think there's a lot of truth in that. So we've trained a lot of the people in this room to think in a certain way. We need to retrain them, because now the risks are double-sided, two-sided.
Just one sentence. It's just that where I agree the risks are double-sided, we need to remember this is a dynamic system. So the bank or bank rate or central policies, let's take it away from the Bank of England, central bank policies, got to decide, are they adding to the risks with the demand that they might be injecting into the economy on an ongoing basis, given the level of interest rates? And that is another risk on top of the balance of risk that you might see.
Correct. So I agree with that. Can I just say one thing about that?
Yeah.
I mean, I can see you were upset both because I'm going to talk more and because I started by saying, can I agree with that, right?
I mean,
so I violated both of
Yeah.
your two rules for this thing, so sorry for that. But what I also want to emphasize is yes, I mean, ultimately, not too hot, too cold is we can create a problem, right? So one of the reasons why we want to have this medium-term orientation, we want to be purposeful in what we do, but also cautious in what we do, is, to your point about volatility in financial markets over the last few weeks, we don't want to be a source of problems. We want to be a solution to the problems.
Mm-hmm. Great. Okay, it's over to you. Where's the nice people with microphones? You're here. Great. Okay, can we start? And so if you could identify yourself before we go. So could we start with Lizzie, and then we will go. Yeah.
Can you hear me? Great. Thanks for all that. It's Lizzie Burden, Bloomberg News. I'll try and focus on the medium term. QE, quantitative easings, the current programme is going to wind up next month. What would it take in the economy? What would have to go so wrong for us to get another dose of it? And since the programme's ending, does that mean that interest rates have to be hiked faster and deeper than they would have had to be done otherwise? Thank you.
Great. And can we also have this guy here, and then we'll go back around here.
Thank you very much to the panel for an interesting talk. So please correct me if I'm wrong about any of this, but
So could you just identify yourself?
Oh, yeah, sorry. So my name's Connor Alone, and I work for the Government Economic Service on intellectual property. So the bank is responsible for maintaining price stability through targeting an inflation target. As far as I'm aware, the bank targets Consumer Price Index, not CPIH. And maybe because of the demographics of the audience, I think they might be quite interested in the price of housing, which might be quite interesting to them now or in 5 or 10 years' time. Housing is in one sense an asset, but it's in another sense a consumable good. Why does the bank not target CPIH, and should the bank target CPIH? New Zealand, I've heard recently, has a government that might have tried to pressure the bank to include that in their inflation targeting. Thank you.
Thank you. Okay, great. Should we go with a couple of those? Hugh, do you want to go first?
Okay. Yeah.
I'm not quite sure which one was addressed to you, but sure you can work it out.
Well, I think they're both addressed to me.
No,
it's a bit worrying. So, I mean, let me say a few things about, QE. So I think we are bringing QE to an end. QE has done its job. QE has come with some baggage. So personally, I am quite relieved that we are bringing QE to an end, because some of that baggage is difficult. And it's good that it's done its job. We have moved on, we've crossed the bridge, we've got the momentum, all the things I said earlier. One, I think, key aspect of the program for the future for QE that the MPC has set out, I mean, it actually set it out before I joined the committee, so, but I mean, in a sense, I'm embracing it, is that we are moving to a world where QE is going to be parked, I think. And we want to unwind QE in a gradual, predictable way so it doesn't disturb markets. And I think the natural implication of that is that we're trying to refocus attention in terms of how we describe our policy decisions and the stance of monetary policy and whether we're trying to make it a bit hotter or a bit colder, using the language I was using before, trying to refocus that on decisions about bank rate. And I hope that will make our decisions simpler to present and communicate and serve to improve the relationship and the understanding and all the good things we talked about earlier. So that's the kind of meta framework here. So you asked kind of in that context, you asked two piercing, difficult questions. So let me try and address those. I mean, the first question I would say is, does it change the path for the bank rate? When we decide the bank rate, at least when I'm thinking about deciding the bank rate, of course I'm thinking about what are we trying to achieve and how do changes in our bank rate decision, how does that pass through ultimately to help us get the economy? What's the transmission mechanism? So I would not be in denial of the fact the amount of QE at any point in time is influencing both those things, right? And if we change the amount of QE, it will therefore influence what we do with bank rate. But I don't think there's any mechanical relationship between the two, right? So QE has different impacts, for example, on longer-term interest rates at different times, depending on the state of the financial markets, the levels of confidence, et cetera, et cetera. So it's just going to become part of our regular assessment of financial conditions, the economy, the outlook for inflation, and our forecasts to incorporate what the level of QE is. So what I guard against, at least in the way I think about it, is sort of thinking somehow mechanically, okay, QE is going to go down by so many billion. I guess we talk in billions these days, right? So many billion in terms of the stock of QE. So therefore, that means what we might have thought in the absence of QE, interest rates might move, in November rather than in February. I don't think there's going to be a mechanical relationship with that. Right? So I think we're always going to have to update our assessment depending on our view, this holistic view in this medium-term lens. So, your first statement, I'll think about it in medium to eight, that's the way you should think about it. That's great. The second point you make is, what would bring us back into the game of QE? And I distinguish sort of two possibilities there. Hopefully, both these possibilities are distant possibilities, right? So the jargon of economics, they'd be sort of tail risk possibilities. Because I have a degree of confidence that we have kind of got out of some of the crisis mode. So one situation would be if we were forced to ease policy, because we were hit by another unexpected downside surprise, like COVID was. 3 years ago, who'd have thought about COVID? And yet, that's all we've thought about for the last 18 months. So I don't know what the future holds, right? Maybe we get that again. If we are forced then to lower interest rates as far as they can go, and maybe they can go lower now, work has been done to allow negative interest rates, as we've seen in continental Europe, here in the UK. I wouldn't necessarily expect that, but it's a possibility. But if we get interest rates as low as they can go, and we still need further easing, QE is a natural tool to employ in that context. But that means we have to have a pretty big negative surprise. The alternative reason we might see interventions is that financial markets misbehave in some way. They seize up. And I think that's much more a story of what happened at the onset of the pandemic, is that the QE introduced then was more to try and maintain functioning of markets, really, than because interest rates have reached the lowest level. So that would be how I'd see it.
So briefly.
On housing, I mean, clearly the bank is concerned about housing. I'll leave Jagjit to talk maybe about this, but we have another committee, of which I'm not a part, which is called the Financial Policy Committee, which is trying to ensure that we have well-functioning housing and housing finance markets, and we avoid some of the boom and bust behavior in housing and financial markets that the UK has been susceptible in the past to. I think by targeting a specific measure of inflation, any specific measure is somewhat arbitrary, I agree, but by targeting it, we're trying to achieve sort of a level of macroeconomic stability and price stability which avoids the sort of boom-bust cycle of which big movements in housing prices have been a part. So it's this stability, I think that's the contribution that monetary policy can make. And I think it is a big contribution, but it doesn't deny the fact that maybe all sorts of problems in housing markets and access to finance, which are coming from other sources.
I'll answer the questions in reverse order, but I'll be brief because I know there'll be more questions. First on the target. The target's set by the government. It's not set by the bank. So, if we have a particular view that the social welfare function that we think is helped by price stability is represented by some other indicator over prices, then that's something we should be talking to the government about. The original target was for RPIX. It moved to CPI in the early, I think 2002 or 3 under Gordon Brown as Chancellor. So, yes, we could think about which is the important thing. And in the short run, there are differences between different measures of inflation. If we look at RPI or RPIX, CPI, CPIH. But the statistical response to you, which is a bit boring, is that actually they all move very similarly in the medium or on a secular basis. So if you look at RPI or CPI or CPIX, again, econometrically speaking, they've got a common trend attached to them. So if we're interested in price stability, perhaps it doesn't really matter which one we target because it's a medium-term objective, as Hugh's been very clear about. It's not about controlling things on a year-to-year basis. There is an issue about house prices in this country. A lot of it will be helped by building more houses, which is outside of the remit of the bank as well. But we can certainly talk about that another time. QE, can I just... it's such a big...
I know, but we haven't got another panel.
I know. Look, it's not billions, it's hundreds of billions. It's huge, QE, and I think it's a major headache in terms of how we get rid of it. Just because we've stopped buying bonds doesn't mean it's gone away. 40% of GDP is held at the bank in the asset purchase facility as an asset. It's a long-term asset that has a short-term liability. It's backed by reserves that are overnight reserves. Because the asset purchase facility is carrying a lot of risk if bank rate were to go up. And I don't for a minute think that the bank didn't raise interest rates because it has to pay more on its liabilities. But a lot of us think inflation is stabilised with an independent central bank because it has no incentive not to hit its inflation target. But if it has a large balance sheet at its disposal, which will be more costly for it to service if interest rates rise, there is a question mark there. I can hear Hugh sighing because there's an indemnity, but that indemnity is not being published, and I think that's an important thing for us to think about. It's a big headache. And QE worked because financial markets don't want to absorb large quantities of debt without the price of that debt falling and interest rates going up and potentially adding further constriction to demand in the economy. However we reverse it, there is a significant danger that financial prices will start to fall so that financial markets can absorb that level of debt. How we manage that, now it could very well work in the way Hugh said, that if markets are sufficiently liquid and a sufficient appetite for UK debt, that debt could be reabsorbed without it, markets phrase coming up, broiling financial prices in a way that would lead to volatility or an increase in interest rates to which the bank would have to respond. But I'm not convinced there is a plan in place at the moment to deal with that. I put out a proposal in the summer on how the bank can think about the asset purchase facility and get rid of this huge liability mismatch. Short-term short-term liabilities for which the interest rate may go up, and assets that are held that are very long-term. There needs to be some swaps, but actually the responsibility for that is back to Treasury, not to the Bank of England.
Great, and everyone can go and read that paper. Okay, so
Absolutely.
We're going to have one more round of questions, and I'm going to your definitions of brief are interesting.
Yeah.
We will reevaluate those. So can I have? I can't only ask the journalists, but okay. Can I have this gentleman here, and then can I have Isha, please?
Thanks. Whilst interest rates
Sorry,
are low...
could you identify yourself first?
Pardon?
Thanks. Could you identify yourself first?
Oh yeah, Jeff Crocker, independent economist. Whilst interest rates are low, isn't it true that actually the conditionality of interest of loans is massively higher? So if you're a business today, you've got to demonstrate significant existing EBITDA and net assets in order to get a loan. So, this is discriminating in favour of existing businesses and excluding new starts. On the bank's question, doesn't the holding of 875 billion of government debt by the bank push us to a place where it's equivalent to debt-free sovereign money? And doesn't this allow us to reconsider whether government expenditure needs to be debt-financed or can be sovereign money-financed? And finally, isn't it a scandal that the bank is only allowed to buy these bonds in the secondary market, thus creating massive risk-free margins for traders who are allowed to participate in the primary market?
Great, thank you.
Goodness me.
Yeah. Yeah, I don't know if you were expecting to have a lunch break, but actually okay, and then finally, Isha.
Times. So you described it as being a difficult, uncomfortable time to have joined the bank. Can you just reflect a little bit on how you've had to maybe change your own personal style of communication given the last interest rate decision and how you're thinking about communicating these messages differently now? And to your point of saying that the central bank can't do anything about supply issues, but that's partly what's driving inflation. Nonetheless, interest rates are going to go up anyway. And then my second question on the dot plots, you said you didn't have enough data or information to be able to do this properly. Do you therefore think that it causes confusion in the US? Do you think the Federal Reserve should maybe reconsider publishing dot plots?
Okay, so we've got 5 questions there. All right, so yeah, we need to get lunch. So we're going to have a kind of quick fire.
All right.
Don't need to answer those.
You don't need to answer those. Okay, all right, go on, Hugh.
Can I
take it away.
disagree? No. Yeah, I do feel like, I mean, those are excellent questions. And each of them deserves a session unto itself. And I should have written down all the questions so you can keep me to account. I mean, generic overview response to the questions about QE, I think a lot of the things you point to is what I talked about as the baggage of QE. I would push back against the specifics of what you say. I mean, I don't think that will surprise you. What I would emphasize is this, is QE is conducted by the bank in pursuit of its price stability objective, its inflation target. It's important for the credibility of the framework, and in particularly the credibility of that target and monetary policy, that pursuit is done in an independent way. Right? So central bank independence is seen as like a core element of what has built the credibility of the inflation target and helped to achieve this kind of prolonged period of low and relatively stable inflation over the last 30 years or so in the UK, which is different from the preceding history that we grew up in.
That's right.
And I think some of the things you're pointing to would put that independence at risk by blurring the relationship between monetary and fiscal policy. So that is the answer to say is we should look carefully at and preserve the independence of monetary policy, and the institutional structure of how governments fund themselves is pretty core to that. So things like secondary market purchases versus primary market purchases, there's a lot of details there, but we should preserve the idea that there's independence of monetary policy, allowing monetary policy to do what it needs to do to meet its target and not be concerned about the cost of its liabilities and things like that in the way. So that's, I appreciate that you had more specific comments and I haven't addressed those, but that I think is what I probably can say and not upset too many people too much. On the questions around communication style and so forth, look, I'm not going to make a statement about what the Fed should or should not do. I had a previous life working in financial markets. I don't think the dot plots met my criterion for good central bank communication. I'm not sure they were transparent or honest or clear. And I think those are the 3 principles that I would be looking for, right? So I guess I did say something about the Fed in saying that. But
your press officer just fallen off his chair.
In terms of how I would amend my communication and lessons to be drawn, like I'm in the learning business for sure, and I've described like the principles I would like to follow in my communication. But I do think that we're entering this new phase that I've described, and the learning is on both sides. And someone needs to provide the kind of commonality here through time. Because if everyone's changing on both sides, you never get this convergence to a common understanding. So, maybe this is a way for me to conclude, what would I want to be clear about? I would want to be clear that we are trying to achieve our 2% inflation target, and we will achieve it, right? In a world of lots of uncertainty, that is something I can be very clear about. What do I want to be honest about? Well, I want to be honest about the fact that, as you've said, we are in an uncomfortable place because inflation is higher and set to higher than our target and set in the spring of next year to flirt with 5% levels, which are even higher than they are now. That is an uncomfortable place to be, but that's what forces us to send this directional signal that policy will need to adjust to in order to achieve our target over the medium term. So, I mean, it's painful, but it's honest about that pain. And where I want to be transparent is to say, on any decision and in any assessment of an individual piece of information, it's a finely balanced decision. So I said, I think, in an interview I gave ahead of the November decision, I think I said all those three things. And I would say them all again today, and I guess I tried to say them just now, because I think they're true.
Well, thank you. Thank you to Hugh, thank you to Jagjit. Something I should have said at the beginning but forgot because I was caught up in the excitement was thank you to ESRC for making this event possible. And thank you to the wonderful people who have provided us all lunch. So yeah, thank you and enjoy.